Hello, beautiful people. Welcome to another brand new week of the ITU Forex class. And this one is exciting because we're going to be talking about something which is actually dear to my heart, which is a technical indicator, which a lot of people kind of take for granted. Okay, so there are lots of, just like with any other very, very common tool, a very popular tool in the trading industry, there are many ways that traders tend to use this indicator to identify trading opportunities in the market. And since there are lots of ways that traders tend to do it, there are also right and wrong ways to approach this. Okay, so that's the indicator. Enough of the ambiguity already. So the indicator which we're going to be talking about in this week's edition of the class is the relative strength index indicator. I know if you've been trading for any length of time, you've probably heard about it. It's more commonly referred to as the RSI indicator, okay? So I know you might have probably heard about it, and maybe you've learned a thing or two about how to use it, maybe you've not. And that's what this week's edition of the class wants to address, okay? So if you just learned one or two things about the indicator or one or two things about how to use the indicator, we're actually going to be talking about how to use it properly, okay, to help you find low risk, high probability trading opportunities in the market. And without wasting any more of your precious time, let's dive right into it, okay? So first things first, the RSI indicator, before you can learn to use it, you obviously need to learn how to add it to your charts and how to read it and all of that, okay? So in order to add it to your charts, if you're using the MetaTrader platform or any other trading platform for that matter, MetaTrader specifically, because you'd want to click on the Inserts tab, the indicators, hover your mouse's cursor over the indicator, the indicators drop-down menu, and then hover your mouse's cursor over oscillators, because the relative strength index is under a category of technical indicators which is referred to as the oscillators. The reason being is because the indicator, it fluctuates between readings which are between the levels of 0 and 100. Okay, again, we're going to talk about this at length as we go on in the class, but because it oscillates between these readings, okay, the highest it can ever read is 100 and the lowest it can ever read is 0. It's called an oscillator, okay, and it's grouped under this group of technical indicators because it oscillates. It just like a pendulum. For any of you who have attended physics classes in the past, science classes, most of the times what this oscillation means, okay? So without getting too sciencey and all of that, this is just what you need to do on your charts, okay? If you're using MetaTrader, go to Inserts tab, hover your mouse's cursor over the Indicators tab, and then under the Oscillators category of technical indicators, click on the Relative Strength Index. Now, as you can see, just like with any other technical indicator, there are fields for you to input the custom parameters that you want to use for the particular indicator. In this case, for the RSI, you can change its period. Period in this sense simply means the number of bars that it's using to calculate its reading. So, for example, if we were on the daily time frame of this chart and we left this at the 14 period level reading, this would simply mean that the RSI indicator is going to be taking the last 14 bars or candles on the chart and using that for its calculation, for its formula and all of that, to arrive at the lines that it draws on your chart, okay? So basically, if you just want to use the RSI indicator, and you're not doing any fancy weird optimizations and all of that, I would just recommend going with the standard 14 periods period, okay, for now, okay? And then just for those who are curious, if you wanted to change what the RSI is going to be using to base off its calculations off of, if it's the closing price of the last 14 periods, that's if you're using the 14 period here, then you just choose the closing price. If you're using the opening price, you select that here, or whatever the reason might be here, okay? So we're just keeping things simple here, and we're using the closing price. For the color, there are lots of colors you can use to customize your RSI indicator. You can make the line either dotted lines or whatever. If you want to make it thick, all of this, you can do all of this here, okay? We don't need to change anything here. And then this is for those who want to have it shown, have the indicator displayed on maybe a couple of time frames, but not all of the time frames. So if you want that setting, you can choose to toggle off all time frames here and select the time frame of the indicator that you want it to show. To make things easy for you to see, let's assume we want the RSI indicator to be displayed only on the daily time frame. In this case, you can see that I'm on the 1 hour time frame, and on the parameters, we've selected our period, we've selected the color and the lines, the width and all of that. And here we're just going to select OK. So you can see that I've added this indicator to the chart, but it's not showing on the chart because this is the 1 hour time frame. If we go to the 4 hour time frame, again, this is just a plain chart. The reason is because we've selected the RSI to be displayed only on the daily time frame. You can see the line is quite thin here. Okay, so to make it a little more visible, I'm going to select this line with the second one here, just to make it, or let's just go with the third one to make it a little bit more visible. You can see we have it on our charts here being displayed. Okay, so again, because I selected it to be only display on the daily time frame, you can see it's only being displayed on the daily time frame. When we go to any other lower time frame or higher time frame, it's not going to show the RSI. But that's not what we want to do. So we just go back to visualization, click on all time frames, and then we're just going to click OK. And here you can see now the RSI is being displayed on all time frames. So now, how to use the RSI indicator? There are a lot of ways, just like I told you, there are lots of ways that traders tend to use this indicator. But again, there are lots of ways doesn't mean that all of the ways are good ways to use it, okay? So to give you an example, you need to understand context. We've talked about market structure tons of times in these classes, okay? And the reason why I'm mentioning this is because one of the ways that traders tend to use the RSI indicator is for gauging overbought and oversold scenarios in the market. Again, just like you heard it, when the indicator, you can see that we have this dotted line in the indicator window at around the 70 reading here. And then we have another dotted line here at around the 30 reading here. So one of the basic ways that technical traders tend to use this indicator is when the reading of the indicator goes above the 70 line, they tend to attribute that reading as a price being overbought on the charts. And so that's kind of like a sell signal. Yes, just like with anything in trading, you can see that this time when it crossed above the 70 region here, you can see that immediately we had the formation of bearish engulfing candlesticks. Price was finding it difficult to break above this resistance area and all of that. And this particular setup was a good short trading setup. So this would have been a good call. Okay, now does this mean that anytime the indicator goes above 70 you just sell? Of course not. And the reason why I said you need to think about these things in context is because one of the ways that you would not want to use this indicator is for you to only take readings of when it's above 70 you sell and when it's below 30 you buy. The reason being, if the market is in a strong trend, price can go way above this 70 line and you'd think it's a sell, especially if you're not using proper risk management. You'd sell and then price would just keep going against you. It's because you're basically trading against the trend. Okay, I'm going to look for an example of this to show you in just a minute. Okay, but I just want you to understand that this doesn't mean that every time you see the indicator crossing above the 70 line, you should just sell. Especially if you're using a technique which does not require the use of stop losses. If you're using stop losses, then almost anything can work. The reason is because if you're using stop losses, for example, let's say you're risking 1% of your account capital on each trade you take. Okay, let's give an example like this. Okay, so let's say you're risking 1% of your trading account capital on each trade you take. And as you can see from this example, when price crossed above the 70 line, we had this sell signal here. And let's say your stop loss is above this swing high, for example, and you're aiming for a 1:3 risk to reward ratio. You can see that this trade would have easily hit your profit target, even if you were aiming for a 4 profit target. Meaning, if you're risking 1% and you're aiming for a 4% profit on each trade you take. Now, if this is the way you're using this indicator, meaning when price crosses above the 70 line, you sell. And when price crosses below the 30 line, you buy, because automatically when price crosses above the 70 line, you're assuming that the indicator is overbought. And when it crosses below the 30 line, you're assuming that it's oversold. And so that price is oversold. And so you're buying or selling immediately. Again, this would not be the ideal way to do it. And the reason why I tell you it wouldn't be the ideal way to do it is because if the market is trending then you can see that the indicator is going to be overbought for a very, very, very long time. I'm going to show you examples of that. But the reason why I bring this up is because it can still work. If you're using a 1:4 risk to reward ratio, for example, meaning every time you're risking 1%, you're aiming to make 4%, and then you take like 100 trades. For this particular example, let's assume, let's just an assumption, that you have a win rate which is only 35%. So out of those 100 trades that you take, only 35% of them turned out to be winning trades. And as a result of this, 35% of them that turned out to be winning trades, each one of them brought you a profit of 4%. So 35 winning trades times 4%, which was the profit brought for each winning trade. Okay. So in this case, you would have had a gross profit of 140%. Now, what about your losses? Remember, 65% of the trades you took were all losers. And so since you are risking 1% on each trade you took, these 65 trades that you lost would have brought in a gross loss of minus 65%. So when you subtract your gross loss from your gross profit, you'd still end up with a very good profit of 75%. So that's why I said with proper risk management, meaning you're keeping your risk consistent and you're aiming for a risk to reward ratio, which is also consistent across the board, you can almost make anything work out, no matter how bad your win rate is. Okay. So just because I say the ideal way is you don't want to sell when price reaches, when the indicator crosses above 70 because it's overbought, because price is overbought, or you don't want to buy when the indicator crosses below the 30 line because price is, I meant oversold when it crosses above 70 and overbought. Overbought when it crosses below the above the 30 line. That does not mean it's not going to work out. If you're using proper risk management and all of that, it's definitely going to work out. Now, let's look for examples, okay? Let's look for examples because most times we learn better by examples, okay? So I want to show you what the argument I was making earlier on, okay? Now, here's an example, a clear-cut example of what I wanted to make you understand. Remember I told you that in trading, we talked about market structure. And the thing we talked about with market structure is that when the market is trending, if it's an uptrend, then usually price is going to be forming higher highs and higher lows. Okay, so price is going to move up a little bit and then it'll pull back and then it'll move higher, pull back, higher and pull back. It will keep doing this as long as the trend is intact. Okay, now you can see that this trend was actually this particular pair. It was moving with the market structure of a downtrending market. It was forming lows, lower highs, lower lows, lower highs, lower lows, and then all of a sudden, price found it extremely difficult to remain below this lower high. And so this was our first warning signal that the market structure is shifting, is changing. There's a change in character. So price is switching from being a downtrending, being in the downtrending market to switching to the uptrend, okay? Because it broke above this. Now, immediately after it did this, we started having price forming higher highs and higher lows and all of that. But when you take a look at what the indicator is doing here, the reading here, you can see that it's above this 70 line, meaning this indicator is saying price is overbought. So if you were just trading with this particular setup, just the way the indicator says price is overbought, and so you sell, and then your stop loss is somewhere here, and you're aiming for a 1:4 again. Let's see whether this particular trade setup would have played out. So let's say you entered, somewhere around here. Your stop loss was somewhere around here, okay? And then in this case, you can see that the trade would have been triggered, and then price would have come all the way to around 2R. It didn't quite reach the 4R profit targets that you're aiming for. Remember from the example that we talked about, and then all of a sudden it reversed against you and hit your stop loss. Why did it do that? Well, in this case, the market is in an uptrend. And you can see that the indicator is telling you that price is overbought. It's overbought, meaning it looks like it can't move any higher. But then that's just a slowing in the momentum because you can see that obviously price would have hit your stop loss and continued moving higher. And again, the indicator is telling you that price is overbought. Again, you would have entered somewhere here and price continued moving higher. And that's why I said context is important. If you want to trade this indicator, one of the basic ways that traders trade it is when it's above 70, they consider price of the instrument that they are analyzing to be overbought. And so they just sell. And when it's below 30, they consider the price of the instrument they're trading to be oversold. And so they just buy. But again, I told you, it's not as if it's not going to work. If you have proper risk management, you're keeping your risk consistent on each trade you take, and you're having a good risk to reward ratio, from the example I gave you, like 1:4, even if your win rate was just 30%, meaning let's say you take 100 trades and you only won 30 out of those 100 trades, you still end up being profitable because you're having good risk management. But is that the ideal way you want to use this indicator? Obviously not. The reason is because if the market is trending, trends tend to last for a very long time and they tend to move very strong. And so if the market is trending and you're using this indicator to just identify buy and sell signals when when the indicator is overbought or oversold, then you're going to get stopped out a lot of times. If you're okay with that and you understand the risk management, go ahead. But a better way to use this indicator, which in my humble opinion is it's going to improve your win rate a little bit and help you with catching low risk high probability trade setups, is to use it in context. Again, let's assume that you're using this indicator. You want to use it while also analyzing other factors in the market. So what's the current market structure? Are we in a bullish trending market or a bearish trending market? For example, now, we know that when price is forming higher highs and higher lows, obviously, we're in an uptrending market. And so you can see that for this particular pair, this particular time frame, price was forming lower lows and lower highs, meaning we're in a downtrending market. Lower lows, lower highs, we were in a downtrending market. And this was our previous lower high. So if price is truly in a downtrending market, price has no business whatsoever breaking above this lower high. It should respect this lower high and then continue moving down to break below this lower low. But then price failed to break below this lower low. It tried multiple times. It couldn't even test it equally, okay? Forming equal lows. It couldn't even do that. And then all of a sudden, it that is supposed to have no business testing this previous lower high, price came all the way and tested this lower high and even broke above it. So we've now changed character from forming the market structure of a downtrending market to now trying to start forming the market structure of an uptrending market. In this case, when you see this is happening on the charts, then you can look to consult this indicator, okay? And look for context and go, okay, now price is doing this, and then price is now trying to break above this level, for example, and then now it's switching up. So you can decide that, okay, since price is respecting this level and it's now going up for the indicator, when it crosses above the 50 line, for example, then I'm going to buy this currency pair and I'll try to catch the move, okay, to the upside, because since now the market structure that we're having in the market is higher highs and higher lows, then when price breaks above the 50 line of this indicator, there's a high likelihood that price is going to continue moving up. Is the 50 line apparent on this chart? Obviously, it's not. So to add the 50 line on the RSI, you just need to double click on the indicator if you've had it added on your chart. If you haven't, just click on the Insert tab, and just like I showed you earlier on. And then when you go to the levels here, you can see that we've got this dotted lines for the 30 and the 70 levels. So on the charts now, all you need to do is just click on Add, and then type 50 here, and then that's it. Just click on OK. And now you can see we have this 50 line, this middle line. Again, I told you that some traders use this indicator when the indicator reading goes above 70, then they're going to sell because they assume that price is overbought. And when the indicator's reading goes below 30, they assume that price is oversold, and so they're going to buy. But other traders use the 50 line instead. So what they do is when the indicator's reading is below the 50 line, they assume that the market is bearish. And so when they see any trade setup that says go long or something, they're not going to touch that trade setup with a 10-foot long pull. The reason is because they assume that since the market is bearish, then they have no business selling, going long in that particular market condition. But when it crosses above that line, and just like with the example I showed you earlier on, we have the market structure of an uptrending market. We've just had the change of character here, and now we've got price breaking above this level. And so we're waiting for a deep retracement before we just get in on the trend long also. You can see that that particular cross above the 50 line on the indicator happened somewhere around here, which coincides with when price formed this price action here, leading to the formation of this bullish engulfing candlestick, okay, after this price rejection. So you could have, if you are using this technique, okay, this this technique for identifying trade setups based on using the RSI and market structure in conjunction with market structure, then you would have seen this trade setup somewhere around here, taken this trade with a stop loss below this level, because the idea is if price is able to break below this level, we have no business being in this trade because the setup would have been invalidated. And so if you took this trade here, and you're aiming for a 1:4 risk to reward ratio, you can see that price would have easily hit your profit target. Immediately it hit the profit target, it actually came, it retraced down a bit, but this would have hit your profit target. Okay? So the reason, if there's one takeaway I want you to take away from this class, is the fact that you don't want to use the RSI indicator in and of itself to identify, overbought or oversold conditions in the market, and just when it goes overbought, you just sell, and when it goes oversold, you just buy. You don't want to do it like that, because the reason why you don't want to do it like that is because if the market is trending very strongly, then you're going to take a lot of L's, especially if you are not trading with proper risk management. So let's say the market is trending to the upside and you saw that price is overbought here and you sold. And then instead of risking 1% of your account, you're risking something like 5% of your account. And then you don't even respect your stop losses, because if price was to just hit your stop loss, you'd lose that 5% that you were risking. But when you see that price is very close to hitting your stop loss, you just delete the stop loss and let price to just keep going against you over and over and over again. In the situation like this, it's easy for price to just go all the way up and just blow your account. Okay, so if you're not trading with proper risk management and you're using the technique of the indicator to buy when it's oversold or sell when it's overbought, then couple that with improper risk management, that's just a recipe for disaster. On the other hand, what I recommend is for you to use the technique which is trading in context, trading with confluence. Okay, so you first analyze what the market structure is, and then after you find what the direction of the market structure is, then you actually look at the RSI to see whether it's trading above or below the 50 level. So because if it's trading above the 50 level, the market is bullish. That's the assumption here. And if it's trading below the 50 level, then the market is bearish. So you can use that as a means for you to identify low risk, high probability trade setups. Another example would be, you can see that price was actually stuck in a range somewhere around here on the chart. We've talked about range-bound market conditions in the past, but just as a refresher for those who are joining us now, when price is finding it difficult to break above resistance areas, and it's finding it difficult to break below support areas, it's just stuck in between ranges of support and resistance, just going up and down, up and down, up and down. This is what we call a ranging market, because ideally, we want to trade when the market is trending. So when it's forming higher highs and higher lows, just like I showed you with this example, or lower lows and lower highs. Okay. So in this case, we would have not paid any attention to the RSI indicator. But once price broke below this low that it found difficult to break below, and then it started forming lower lows and lower highs, then we now have an established trend in the market. So if we're trading based on context, we know that if price is forming lower lows and lower highs, the market is in a downtrend. And so when price pulls back from this area, because it can't break below the level, we know that ideally, if this downtrending market is supposed to really continue to the downtrend, if it's really strong like that, then price is going to continue moving to the downside. And it should have no business breaking above this area. And so when we see that price reaches all the way up here and then it starts forming this resistance, okay, it starts finding it difficult to break above this area, we'll now take a look at our RSI based on the second technique. And once we see it break below the 50 level, you can see it coincides with this area here around the chart. So you would have taken a short trade setup here. And depending on the risk to reward ratio that you're going for, this trade would have either hit your profit target or hit your stop loss. So if you were taking the trade somewhere around here, okay, and then your stop loss was somewhere around here, okay, then this trade would have barely missed your profit target. And then this would have been a painful trade because it would have come almost just like 5 or 10 pips close to your profit target, and then it failed to hit it, only for it to reverse and hit your stop loss. But this is the thing. I don't want to just cherry pick trades and show you trades that work. I want you to understand that in trading, in fact, the technique that I use to trade the markets now, most of the times my win rate is below 50%. So I lose more than I even win. But I still end up being profitable. The reason is because I have proper risk management. My risk is consistent. And when I win, the average profit from my winning trades are much larger than the average losses from my losing trades. So I don't want you to go thinking that, okay, this technique is going to give me winning trades like 80 to 90% of the time. Absolutely not. In fact, I want you to go with the mindset that you might even lose more times than you win. But that is what makes risk management very important, because even if you lose more than you win, but if you have proper risk management, you still end up being profitable. And that's the crux of it, okay? Regardless of the trading strategy or trading technique you choose to use, if you're using proper risk management, you would still end up on top. So this pretty much brings us to the end of this week's edition of the class. And I would like to use this opportunity to let you guys know that we also have tools which are designed to help you trade on your behalf. They will identify the low risk, high probability trade setups for you, do the proper risk management for you, place those trades for you, even when you're away from your charts. You just follow our instructions, set everything up on your VPS, and even out when you're out there, doing the things you love, if you're a busy person, attending to your job, or if you're, whatever the case might be, if you're sleeping, all of that thing, the EAs will trade on your behalf with proper risk management and all of this, okay? So if you're interested, please reach out to us and we'd be glad to assist you set everything up after the enrollment and all of that. So please, if you're interested, reach out to us on the socials or drop a comment in the comment section, and we'll be more than happy to walk you through how to set everything up, okay? Once again, thank you for taking time out of your busy schedules to come to this class. I sincerely hope you got enough value from it that you find it valuable, okay? I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week, and God bless you all. Cheers.